The global realignment of supply chains is driving a sustained influx of foreign direct investment into the ASEAN region. Capital is moving to capture the growth mapped by the International Monetary Fund, which forecasts a 3.5% global GDP expansion for 2025. To capture and direct this liquidity, ASEAN member states have moved away from discretionary tax negotiations. They now deploy highly formalized, rules-based incentive matrices. Using data from the 2025 EY ASEAN Incentives Report, we can structurally compare the tax architectures of two distinct markets, Cambodia and Indonesia. Cambodia has engineered a framework optimized for foundational growth, designed to attract baseline manufacturing capacity. Indonesia has deployed a different model, optimized for value chain escalation, targeting advanced manufacturing and industrial integration. Multinational tax strategy in ASEAN no longer relies on seeking generalized tax breaks. Executing a profitable market entry requires mapping specific investment profiles against a sovereign nation's development priorities. This table details the Cambodia incentive regime overview, introducing the Qualified Investment Project, or QIP. This is the primary vehicle the government uses to administer targeted corporate incentives. QIP explicitly forces investors to choose their financial advantage. Option 1 targets operational expenditure, granting a full tax on income holiday lasting between 3 and 9 years. Following that total exemption, the state imposes a 6-year graduated discount period. Corporate tax liabilities incrementally step up in 2-year intervals, scaling from 5% to 10% and finally 15%. Option 2 offers a different financial utility. Instead of long-term operational margin enhancement, it targets immediate capital expenditure recovery by authorizing a 40% special depreciation allowance on production assets. This line chart plots the diverging cash flow impacts of these two options over a 15-year horizon. Strategists must evaluate whether their specific supply chain deployment benefits more from long-term operating margin protection or from rapid upfront asset depreciation. To further subsidize these foundational industries, the architecture layers on secondary operational incentives, including 100% export duty exemptions. It also features a minimum tax exemption, provided the enterprise maintains strict independent audits and proper accounting records. By structuring its incentives this way, Cambodia offers smooth, multi-year margin enhancements engineered to attract and anchor baseline manufacturing. In contrast to Cambodia, Indonesia focuses its sovereign tax policy on moving domestic production up the complex industrial value chain. This list outlines the Apex incentive, a tax holiday offering up to a 100% corporate income tax reduction. It is restricted to 18 specific pioneer industries. The targeted sectors prove the state's focus on advanced manufacturing. Only capital-intensive operations like automotive, ship, and train main component manufacturing qualify. This table maps out Indonesia's formulaic authorization system. It explicitly links the total dollar amount of capital expenditure to the number of years granted in the tax holiday. The entry threshold is set at a minimum equivalent investment of $35 million to receive the initial 5-year holiday. Securing the maximum 20-year holiday demands a capital commitment exceeding $1.83 billion. This sidebar outlines the quantitative PMK 130 scoring guideline. It allows companies falling outside the 18 designated industry codes to still compete for the holiday. Scoring 80 points or higher across these metrics, measuring new technology introduction and supply chain interconnectivity, makes the tax holiday available. For non-pioneer expansions that do not meet these requirements, the state offers a fallback tax allowance, trading full tax elimination for a 30% investment deduction on tangible fixed assets. Indonesia's pioneer framework is a calculated filter. The state surrenders corporate tax revenue only in exchange for high-tier capital expenditure and structural technological advancement. Beyond national tax regimes, both Cambodia and Indonesia deploy geographic ring fencing through special economic zones. Operations within these zones receive distinct baseline benefits, isolating specific geographic nodes with 10-year tax holidays for developers and the elimination of import duties. Indonesia also utilizes behavioral super-deductions. These mechanisms directly reduce a corporation's gross revenue to subsidize the cost of building specific onshore capabilities. This text details a 300% super-deduction applied to gross revenue, designed specifically to underwrite the cost of conducting eligible research and development entirely within Indonesia. Furthermore, the state offers a 200% gross revenue reduction to corporations that fund vocational apprenticeships and internship activities. The most significant example of geographic ring fencing in the region is Indonesia's Nusantara capital city, or IKN, megaproject. To attract anchor investments, the state structures specific, unprecedented incentives for this zone, including massive tax holidays that reach a 30-year duration. Resident corporate taxpayers operating within the IKN boundary also gain access to an isolated 350% research and development super-deduction. These behavioral modifiers and ring fences provide a mechanism for governments to target foreign capital toward the specific technological and geographic gaps in their national infrastructure. Multinational enterprises cannot approach the ASEAN region as a monolithic entity. This matrix charts the strategic reality, evaluating these tax regimes based on capital intensity across the horizontal axis and technological complexity on the vertical. Cambodia's QIP regime populates the lower left to mid quadrants. Its utility is focused on foundational infrastructure and export-driven manufacturing, targeting operations that require smooth, multi-year margin enhancements. Indonesia's Pioneer and IKN frameworks occupy the upper right quadrant. Indonesia's utility is centered on high-threshold capital deployments, the generation of advanced intellectual property, and direct alignment with state megaprojects. Both systems force corporate strategists into a definitive structural trade-off: prioritize rapid capital expenditure recovery or secure long-term operational tax suspensions. Optimal site selection in modern ASEAN demands architecting your investment's financial profile to match the sovereign intent of the host nation.